Now, Trading Day, live.
Welcome back to the program. Checking in on how markets are tracking. The ASX 200 in particular in positive territory this afternoon, half a percent stronger at 6,189 points. Materials helping to lead the gains. We'll tell you why shortly. Aged care stocks continuing to feel the strain though today. There's Estia, Regis, Japara and Avio. Four of them that are taking a dip today off the back of that Royal Commission into the aged care space that was called on Sunday afternoon. Also making news at this hour, Chinese Premier Li saying there's no plans to devalue the yuan in order to stimulate exports in the face of US trade tariffs. We'll talk more with Evan Lucas shortly on that. And the NAB slashing executive pay packets amid evidence of misconduct at the bank and across the financial sector. But let's take a look now at the commodity space, see how it's tracking, in particular the oil price. Mixed picture there for Brent and NYMEX. Brent weakening by just 3 cents, $79. NYMEX crude at $69.90. Also watching iron ore, which is weakening off slightly. Copper's an interesting story, though. Copper's seeing a nice rebound of late. Over the last couple of months, it's obviously taken a bit of a dip, but demand still staying strong, at least in the meantime. We'll talk more on that shortly. Let's dive further into some of those commodity drivers and kick it off with oil. Markus Helsing of Alpha Broking joining us out of our Melbourne studio. Markus, great to have your company on the program. Let's kick it off with oil, with crude for us, because we've seen sort of multi-months, I guess, of consolidation. We're watching oil going forward. Are you seeing more upside from here is the question.
Yeah, look, thanks for having me on the show, Ingrid. Look, this whole commodity cycle has been really strongly influenced by US dollar movements over the last 2-3 years and or 4 years even. And I might just say the US dollar is very influential on that, in particular with this sort of tightening cycle that we're in with the Federal Reserve. But talking commodities, to us, we find that the consolidation, oil in particular, over the last 3-4 months has been consistent with our forecast, and we still think oil is heading towards $80 a barrel. There is a few bits and a few ifs and buts out there in terms of some technical commentators out there. If you look at the whole story, and if you add on, for example, also natural gas, which is an asset that, due to, as a side product of fracking in the US, being quite oversupplied and hence depressed in price, we find that as a whole, the whole energy sector in the US in itself, let alone the rest of the world, offers an enormous value proposition when you look at the price, the consolidation, where we're at. And so as far as oil is concerned, we think we're still heading to $80 plus a barrel, probably over the next 2 to 3 months.
Interesting, because we're watching OPEC meeting on Sunday and non-OPEC producers as well to discuss these compliance with output policies. But you've also got Bloomberg reporting today that Saudi sources basically say they're comfortable with prices above $80 a barrel, at least for the short term. So what are you watching here, particularly with sanctions against Iran coming into force, in November, early November?
Well, one just has to look at the demand side. That's always totally underreported. I mean, I've just been in Singapore only a week or two ago. I mean, you have a look at the oil tankers passing Singapore and going one way, and let alone what India needs. I mean, the demand side has been steadily on a steady incline, and we always just seem to look at the supply side. Now, and there are troubles in the supply side. You don't have to look at Venezuela, you look at Iran, you look at the Middle East as a whole. But really, the demand side is very, very strong. We are still a long way off from driving electric cars and having our houses powered by wind and solar power. We're heading this direction, which is great, but the dependence on oil is just massive. So we just see generally, as long as the world economy holds up, which we think will be the case for the next 6 months at least, if not 12 months, there's no reason to believe to see oil at $80 or even higher.
Okay, moving on from oil, I want to talk gold as well, precious metals. Interesting space in general, precious metals. Usually you see gold sort of rise on perhaps as a safe haven play on geopolitical tensions, what we're seeing overseas, but none of the macro concerns have really played into gold. What are you seeing going forward? What are you forecasting in terms of range, I guess, for the gold price and other precious metals as well?
Yes, look, I mean, again, gold, like many other commodities, has really been under massive pressure from a rise in US dollars, the yield play, if you like, that everyone seems to focus on. But also, I mean, generally, I mean, the equity market had the boom of all booms. And what we just see now is, technically and fundamentally, we just believe, if you look at other precious metals, such as platinum and silver, for example, we just look, technically, they look to us like a very, to be sitting in a very exhaustive closed the bear market. Things can always go a bit further than you think, but we actually do believe that at current levels, not only do we believe the US dollar is in a topping out formation, broadly speaking. I mean, we have the Chinese starting to pull out of US treasuries, and the treasury bond market is heading south. We generally have, so from the US dollar point of view, we think we're going to get, from here onwards, we're going to have a positive support for gold and silver. And really, the US dollar has an important role to play about that, because it has been the quasi-reserve currency for 50, 60 years now in the world, if not longer. And it's now, we believe, there'll be a big challenge on it. I mean, what moves the currency? A currency is dependent not just on interest rate differential, but on a current account differential, which doesn't look pretty for the US. You look at the debt, net debt or budget situation, which doesn't look pretty in the US. And you look at natural demand for US dollars, which generally is still healthy. However, it feels as though it might be in a peaking formation. So coming back to gold and silver and platinum, we just think gold around this $1,200 US an ounce mark has a lot of support. You know, to us, silver and platinum are really the value play. I mean, platinum is trading at a 2004, 2005 level, silver about the 2006 level. And there were levels before these two metals really started to go absolutely crazy. So we really believe they're an enormous value play. Where they head from here, you know, I'm a big bull on that. And I think you should always look at trying to do what hasn't worked the last 5, 10 years. We believe silver and gold are markets that are just about waiting to go crazy on the upside at some point over the next few years. And it is, if you look at individual gold shares, for example, you look at Goldcorp or Barrick Gold over in the US and Canada, you look at New Gold, you look domestically at some of the minor ones, Silver Lake and Perseus Mining, and there is, to us, enormous value play out there, and I'm saying that now for quite a few months. We just added on our positions on all these stocks that just mentioned, and I just think they're an extreme low-risk play at current price levels with a tremendous upside potential.
What sort of impact are you expecting, just finally, when it comes to emerging markets and how that plays out for the commodities space more broadly? Because obviously, as you mentioned, we're seeing divergent treasuries, diverging from the last, at least what we've been seeing recently. We're also seeing the US dollar strengthen, which doesn't bode well for emerging markets, given they're heavily indebted in US dollar denominated debt. What's your take on emerging markets and how that weighs on your commodity forecasts?
Well, in essence, you just summed it up. I mean, these emerging markets, every crisis, I mean, I'm only 58 years old, so what would I know? But once I've seen what I've seen in the 70s, 80s, 90s and noughties, any major crisis in a Western market starts with an emerging market crisis. It's just it's a Groundhog Day scenario. And this is a classic one again. They end up borrowing low interest rate US dollar denominated debt and euro debt. And here we are, suddenly, many of these countries from Turkey to Brazil to Argentina to South Africa, you name it, Russia, they sit on all this debt and suddenly the currency plummets 30, 40% or more. So to us, really, overall, this is just a macro sign there's trouble ahead for all markets in the world. And we still believe that world, on a macro scale, that what we said in January, we believe world asset prices are in a topping formation. We expect them to top this year or early to mid next year at the absolute latest. We just cannot see any major capital gains from here in world asset prices past the next 6 to 9 months. Hence, we have defensive approaches towards shorter dated trading, select stock picking, and be in defensive areas such as precious metals, which we think is paramount into the period that we believe we're heading. And that's not looking pretty. I mean, like in 1987, just to mention that one, we had a top in the bonds in January, and they sold off for 10 months. The stock market caught up 10 months later. Here, we had a top in the US bond market in 2016, 2 years ago, and the stock market's rallied ever since. The bond market in the US had another breakdown just the last couple of days. So at some point, these divergences will come home to roost and will have an effect on key asset prices simply because the cheap money is falling away.
All right, Markus, always appreciate those insights. Thank you so much for joining us on the program today.
Thanks, Ingrid.
Markus Helsing there joining us live. We will, before we head to a break, take you live now to the 6th round of hearings at the Financial Services Royal Commission. Let's take a listen.
We can see from this email, which is on the 30th of May 2017, that Builder A provided the information that UE had requested, which included information in relation to Ms Murphy and her partner's claim.
Right. Yes, I see that, yes.
And the information about that claim, perhaps if we could... we need to see the far right column of the table, which is off the screen at the moment. Insurance will be forwarded prior to repairs commencing.
Yes, I see that. Oh, thank you.
Now, if we turn to 0785 within this document, perhaps if we could have 0785 at the bottom of the page enlarged, we see that on the 31st of May, Mr Mortimer responded to the email from Builder A. Do you see that?
Yes, I do, yes.
And he said, the information provided below again raises flags that correct process under state legislation is not being adhered to, which places our clients and UE at risk. And if we then go to the continuation of that email at the top of the next page, we see that Mr Mortimer went on to say, just need to go to the top of the page.
All right, we'll leave that there. The Royal Commission check in on it a little bit later. But a programming note for you. Peter Strong, Chief Executive of the Council of Small Business Australia, will be appearing tonight on Tiki to talk the Labor Party's super top-up plan for women. The opposition also pledging to phase out the $450 minimum threshold for the superannuation guarantee. We'll get the small business industry reaction from Peter Strong tonight, 6 p.m. Eastern Time on Tiki. We'll take a break. When we return, Evan Lucas joining us to talk the macro, the trade wars in particular, and how China is fighting back. Stick around.